The Spin-off Podcast Network.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV. It's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
I can say to my new Samsung Galaxy S25 Ultra, hey, find a keto-friendly restaurant nearby and text it to Beth and Steve. And it does, without me lifting a finger. So I can get in more squats anywhere I can. 1, 2, 3.
Will that be cash or credit?
Credit. 4.
Galaxy S25 Ultra, the AI companion that does the heavy lifting so you can do you. Get yours at Samsung.com. Compatible with select apps. Requires Google Gemini account. Results may vary based on input. Check responses for accuracy.
When the Facts Change is brought to you by the Spin-off Podcast Network in partnership with KiwiBank, the bank for Kiwi looking to get ahead in business and in life. A bank that delivers expertise and banking know-how, smart advice for business owners wanting to invest, grow their business or diversify. A bank that adapts with technology through the lens of its people and customers. It is a bank with heart that is driven by its purpose. Kiwi, making Kiwi better off. We all love to pat each other on the back when things go well, when we think we can claim credit for something. And all around the world right now, inflation is coming back down to around about 2%. And there's a few central banks who are patting themselves on the back to say, independent inflation targeting central banking works. And New Zealand can take some credit for that. We were the originators of inflation targeting independent central banks. Way back in the early 90s under Don Brash and in the wake of the massive post-Muldoon reforms, our central bank was made independent and given the single task of getting inflation to between 1% and 3%. There was some jiggery-pokery at the start with which numbers to target, but we got there in the end of between 1% and 3% over the medium term. And we had a big conference in Wellington a few weeks ago of the world's central bankers to celebrate 35 years of inflation targeting at the place where it started. And it really became news because the day before it started, Aotearoa resigned without too much explanation, and he was there to host it. And there were some big names there. Ben Bernanke was talking at the conference as well. So, is inflation targeting a good idea? Did it work? Because we just had the most almighty inflation scare, and it hurt. A whole bunch of governments lost their jobs. You know, it really has been a big and bad part of our economic landscape for the last 4 or 5 years. And so this week on When the Facts Change, we thought, let's have a chat with Paul Conway, the chief economist at the Reserve Bank, who effectively hosted the conference with the rest of the Reserve Bank and looked in depth at this question. Did it work? Did our invention actually make the world a better place? That's this week on When the Facts Change. Well, kia ora, and welcome to Paul Conway, back to When the Facts Change, our favourite Reserve Bank chief economist, to talk about a really big conference in the world of central banking that happened in Aotearoa in the last couple of weeks, where some very big names turned up, and there was a lot of talk about central banking and inflation targeting. And Paul, you made a very big claim at the end of the conference that inflation targeting was New Zealand's biggest gift to the world, our most important contribution to human well-being. Really?
I did, Bernard. Yeah, thank you. Kia ora to you as well. It was a massive conference for us. It was wonderful. Some of the best monetary policy thinkers on the planet descended on Wellington for a couple of days. And in my closing remarks, because of course inflation targeting, it was invented here. It was invented at the Reserve Bank and implemented 35 years ago And it's been going strong ever since. It's spread around the planet. It's definitely the default mode of operation for a central bank, particularly across developed OECD economies, but more broadly than that as well. And it's worked, notwithstanding stresses and strains and tests along the way, but it has resulted in lower inflation globally, greater economic stability globally. And I just sort of put it to the audience at the end that it is, quite probably New Zealand's greatest sort of contribution to global well-being. And I know that's a big call compared to jet boats.
And Marmite,
And Marmite.
number 8 wire, all of those things.
I'm going to say, Bernard, I've changed my mind, actually. I think there's a bigger great idea to come out of New Zealand than inflation targeting. And I don't know how I did this, but I forgot about women's suffrage. So I actually think democracy for all is our biggest global wellbeing enhancing contribution, but I think flexible inflation targeting probably comes in at second place, which is still amazing for the people that developed it back in the day here at the Reserve Bank.
So 35 years, it's been going strong and stable, except for the last 3 or 4 years, where you could argue it's had its biggest test globally. Has it failed that test?
I think the last few years have been the biggest test for the inflation targeting framework in that 35-year period. The global financial crisis was also a big test for it. It won't prevent shocks happening. It won't prevent changes in our economy that spark inflation and all of that. But the reason I think we've handled that the framework has handled that well is that inflation is back down, very close to central bank targets globally. So it's that recovery and the fact that people's inflation expectations have returned to around inflation targets, which means that that notwithstanding this very extreme test, the framework has stood up to the challenge of COVID, and there was plenty of talk about this at the conference, but we're still going strong after 35 years.
Yeah, one of the biggest speakers at the conference was Ben Bernanke, the former Federal Reserve chairman, who became well known sort of before he became Fed chair for some comments about effectively money printing, what some people call helicopter money, this idea that when an economy is really down in the dumps and there's no inflation whatsoever, one way to get things cracking again is to give everyone on the ground, and maybe you float it down from a helicopter, some cash and get them spending again. Now, that's a very pure form of money printing, but the big response from some central banks in 2008, and certainly the US Federal Reserve, and progressively over the following years, and then the New Zealand Central Bank and pretty much every major central bank in the world in the COVID crisis was what's called quantitative easing. So that's not the same as throwing money out of the helicopter. This is where the central bank buys government bonds to lower long-term interest rates. But it's been quite controversial. There was some research presented at the conference about the effects in New Zealand. What were the end results of that research into the effects of our version of quantitative easing, which we called the Large-Scale Asset Program?
Yeah, LSAPs for short. So the objective of QE or LSAPs in our case is to essentially it's another tool in the central bank's toolkit designed to lower interest rates. So the central bank, the Reserve Bank in our case, buys bonds, and that has the effect of lowering the interest rate on bonds in general further out along the yield curve compared to what we normally do, which is with the official cash rate. We did that over COVID. It was reasonably controversial at the time and since, and the Reserve Bank copped a lot of criticism about the mark-to-market losses of the bond portfolio that we ended up owning out the back of that as interest rates subsequently increased. The value of our bonds fell, and there was a substantial mark-to-market loss.
Just to focus on that a bit, because there's been, you're right, a lot of coverage about this. Could you explain to people how it's possible for the Reserve Bank to make an actual loss on buying and selling government bonds? Because, the Reserve Bank is part of the government. The government is buying and selling these bonds. And in theory, once you buy a bond and then hold it till it matures, you can't really actually make a loss.
Exactly.
So I'm trying to work out here, who is actually making a loss, or is this just an accounting thing you do?
Absolutely. So if you think about it from a consolidated Crown balance sheet, the questions you're asking are very germane to the answer, and you can sort of work through the economics. And essentially, we just sort of shortened the duration of total net government debt over that period. So that's one sort of aspect of the response to the question. Were LSAPs worth it? That mark-to-market loss, it was on the central bank's balance sheet. But when you think of it in terms of the consolidated Crown balance sheet, you sort of, it changes it up, absolutely, as to where those losses lie and whether they're accounting losses versus economic losses. And the other aspect of LSAPs, which is the research that we presented, that the Reserve Bank presented, we had a very nice paper using a well-developed economic model to sort of trace out the net costs and benefits of LSAPs. And when you do this, and this is a model that we've got from the International Monetary Fund, highly credible piece of economics. We've sort of calibrated it to match the New Zealand conditions because, of course, we bought LSAPs for a purpose. We lowered interest rates for a purpose, and that was to prevent a deep recession/depression in the New Zealand economy when we sort of shut the place down in response to COVID. And also, to prevent deflation, to prevent inflation going through the floor. And the results of this model, suggest that when you net that out, because they were stimulatory from an economic perspective, so that creates greater tax revenues for the government. It means that unemployment is a bit lower than it otherwise would be, so government doesn't have to pay job seeker benefits. And the like. And when you net all of that out, the conclusion that we get to is that the LSAP program, it did help support inflation and output over that period, and it had similar fiscal outcomes to a scenario where LSAPs weren't used. And I want to say this is a model. So the idea of this is just to strengthen our understanding of how to think about these tools, ideally, in the face of real-time uncertainty, and to provide a bit more transparency around the costs and benefits, and really just to take that conversation, just making it a bit more objective. You can't just sort of look at the costs and then have a crack on that basis. You really have to look at the net effects of that LSAP program. And it's very interesting, definitely not the last word on the topic, but the hope there is that we are, A, we're deepening our understanding of how these tools work, and B, ideally we're just moving the national conversation along to make it a little more fulsome in terms of the total risk-adjusted net benefits of QE in New Zealand.
I wonder, though, whether the framing is wide enough, because one of the complaints about QE, some people call it money printing, I think that's a bit crude, but QE at least, is that, it helped on inflation, and if you measure it on an inflation and a employment measure, then it all made sense. But the asset prices, and in the New Zealand sense, another generation watched house prices explode again, and which eventually started to flow through into rents. Do you think the Reserve Bank should or needs, and should reserve banks generally, when they think about inflation targeting, think more widely about the asset price implications, which on the face of it, they don't have to worry about it. That's not in their mandates. But
that's right.
But from a consumer voter point of view, that was the real shock.
Yeah, I think what happened to house prices over that period, it's clear that low interest rates stimulated the housing market, allows people to borrow more and therefore sort of bid up house prices. So it's indifferent to, was it LSAPs that did that, or was it the fact that the official cash rate was, at 0.25%? Whatever the instrument, the result was lower interest rates, which clearly had an effect on house prices. As to whether that matters, of course it matters to the central bank in that high house prices at that time. And, we're sort of seeing house prices have been going sideways over the last sort of 18 months, 2 years. What effect does that have on wealth in the economy? And if people, were people feeling richer over the COVID period, and did that encourage them to spend? And if so, what effect is that having on capacity pressures in the economy and therefore inflation? So we have to worry about house prices, but we worry about the effect that they have on inflation. Like, as you said, house prices are not part of our mandate. We actually touched on this in the conference. And the sort of thrust of the answer, and Dr. Ben Bernanke chipped in on this as well, is that it doesn't make sense for asset prices to be part of the central bank mandate, because they're not prices that people pay in terms of their consumption baskets day to day. And also, there's nothing we can do about house prices. If New Zealand had a housing market or a supply side of the housing market that worked better, if an increase in demand for houses in New Zealand led to more houses being built, that would be great. You would see it in an increase in housing. You wouldn't see it so much as an increase in house prices. And the vibe at the conference was that there's spillover effects of monetary policy, and this is one, and we need to be cognizant of it, and we need to understand the effects of those asset price changes on economic behaviour and on inflation in our case. But ideally, we would just have a housing market that works better, so that we wouldn't have seen that big run up in house prices and subsequent fall and sort of sideways action ever since.
You touch on a really interesting division within our political economy now that maybe we didn't have before inflation targeting, where if you're a voter or a consumer, a business, if there's anyone you have to blame about whether the economy's working, whether inflation's too high or unemployment's too high, you blame the government because it's the one controlling policies on everything. Then we had inflation targeting when the government said, right, we're giving responsibility for inflation, essentially the short-run speed of the economy and its ability to keep inflation between 1% and 3% over the medium term.
Yeah.
That's the Reserve Bank's job, and we're not allowed to interfere in that. And it created this separation where the Reserve Bank does its thing, and it does its thing sometimes with, but sometimes in spite of what the government's doing. It can't really tell the government what to do. The government can't tell the Reserve Bank what to do. And we've come to this situation now where the government thinks of the economy in a short-term sense. It does everything it can to try to reduce pressure on the economy. It says to try to lower interest rates because that's all you need to get your economy going again is lower interest rates. And the Reserve Bank may not say it, but would quite like and has said it in various ways over the years, would quite like the government to be able to change policies to improve the supply side of the economy, as you say, having the responsiveness of the housing market, not to mention other policies that might improve productivity in the long run. But is there a danger here that a bit like the two cricketers in the outfield, yours, mine, yours, and it drops in between them, that we've built a system in which no one takes the blame and we don't know who to point the finger at?
I think us as a central bank, we need to be very clear about what we can and can't influence. And essentially it's where's the business cycle in the economy and what does that mean for inflation? So monetary policy is a pretty narrow tool with a very clear purpose. And it did used to be the domain of politicians. The politicians used to tell the Reserve Bank where to put interest rates. The world over, we saw what we call a time inconsistency problem with that. There was a sort of incentive for politicians to lower interest rates in the lead into an election because it would increase activity in the economy. People would be feeling good about that and therefore more likely to vote for the incumbents in the political process. And it's sort of, for me, it's like often the things that a politician or a government needs to do to get re-elected are not always the same thing that a government needs to do to improve the long-run performance of the economy. So in response to that time inconsistency problem, and again, we pioneered this here in New Zealand, was this idea of central bank independence, that we get a very clear mandate on what our purpose is from the government, and we are allowed to go away and pursue that mandate. And that's been the case ever since. And I do think, the fact that we're in the media every 6 weeks, every time we make a decision, people sort of do think that that's economic policy. It's whatever the central bank is doing with interest rates. That's really what matters. And yes, it's very important, but it's important in a sort of short to medium term. When we're talking about the long run performance of an economy, I mean, again, what the central bank does matters. We know that low and stable inflation is a really important ingredient in a well-performing economy over the long run, but that's only part of it. And I'd argue it's a relatively small part of enhancing our long-run economic performance. So the full gambit of regulatory policy that government have, or the sort of regulatory levers and tools that they have at their disposal, that is what really matters for an economy's long-run performance. Interest rates, less so over the long term. And I would actually argue now, in the context of New Zealand, we're sort of coming out of a recession last year. We're at a turning point. Growth is starting to return. It's not interest rates that are constraining the growth of this economy in the short run or the long run at the moment, given that where we are in the cycle. It's what we call our potential output. It's the supply side capacity of the economy and how much that can grow, and that's very much a function of regulation, of policy settings across the broad range of policies that a government, as I said, has at its disposal, and also the private sector. It's not just all about the government. The private sector has a role to play here in terms of standing up and investing and adopting new technology, et cetera, et cetera.
Yeah, it's not the Reserve Bank's fault or problem that effectively there's a vacuum in that space around longer-term economic policy, because politicians who might have tried structural reform in the past around taxes and investment have felt burnt or felt that it's not possible. And so just through that, the lack of action at the longer run, all of the attention and debate is focused on the short run. So in that short run, though, there is a debate about whether central banks and the government running fiscal policy should be more closely coordinated, because there is a risk that you have a bit like two drivers in the rally car and they're both trying to put their feet on the accelerator and the brake at the same time. And you end up with a sort of a pro-cyclical problem where the Reserve Bank might be trying to tighten monetary conditions, but you might have a government spending lots of money, or vice versa. The government's trying to stimulate and the Reserve Bank's trying to stimulate and the government's trying to restrict. How do you make sure that the two drivers are not jumping on each other's pedals?
Yeah, sure. This again, I think this was really important over COVID. Like, I think on net, fiscal and monetary policy, we overstimulated the economy, which is why we got inflation in the first instance. And the fiscal policy tools being used at that time, they were novel, they were new, and I don't think we fully understood the macroeconomic effects of those tools. And the size of the fiscal stimulus in New Zealand was very large in international comparison as a share of GDP, and also untested. And as it turned out, they were very effective over that period. So I'm sort of saying, well, let's do research and understand that in more detail, so that the next time those tools are rolled out, the monetary policy maker or the monetary policy committee will have a better idea of the likely impact of those tools and will be able to tailor monetary policy accordingly. So it's a very important issue, getting that right mix of fiscal and monetary policy. It depends on the nature of the shock. I would argue that having an inflation target, and ours is 1 to 3% with a focus on 2, and we've got fiscal sustainability rules around all of that. And in normal times, I think that's fine. I think that that sort of keeps. Yes, the macroeconomic effects or the macro stabilization impacts of those two policy tools is going to depend on, whether one's expansionary and the other's contract. We need to understand all of that, but I think our framework in normal times is adequate. But I think when it comes to a crisis such as COVID, and there will be further crises in the future. It's a volatile world out there, so buckle up, fasten your seatbelts. We need to understand this stuff. It's not like fuel, we're through COVID, and sort of back to the great moderation. That isn't going to happen anytime soon. But when there is a crisis, particularly when monetary policy or interest rates get to what we call the effective lower bound, where they can't really easily go down further or go negative as they did in some countries, then I think it's very important to understand the sort of interaction between fiscal and monetary policy. So we've got quite a research program underway at the moment to answer those questions. We're working with the Treasury on aspects of it, and ultimately we want to come up with a sort of a playbook to make the most of what we're learning from the COVID experience, so that policymakers in future will have that at their disposal, and we can sort of end up with a better mix of monetary and fiscal policy for macroeconomic stabilisation during times of crises.
One thing we love to do on When the Facts Change is try and examine how the facts have changed over long periods of time. And 35 years ago, when inflation targeting was going, there were a lot of unions in the world. Often wages were set in centralised negotiations, and sometimes wages moved quite quickly, particularly in that high inflation era during the 1970s and 80s. And also a lot of people were working in full-time jobs, often in factories. But in the last 35 years, there's been a lot of change. The union penetration of the workforce is much lower all around the world, particularly in New Zealand. But also people do different types of work now. They're not working in factories. They might be working from home or part-time or in all sorts of services jobs. How has that changed the responsiveness, particularly firstly of consumers, to changes in inflation? Because now is quite different to 1987.
How to say this? I think our framework now is more flexible. It sort of depends on the industry and how much power labour. You think of a wage negotiation. You've got, management who are there as a proxy for the owners of capital on one side of the table, and you've got workers on the other side of the table. And, it's more likely to be an individual worker here in New Zealand. But people like me, I have good power in those negotiations because of my skills. But not everybody does. So I do think there's a space for sort of collective bargaining. But then, if you go back to the 1970s, the problem with sort of collective bargaining is that it tends to make inflation stickier or persist into the future. So if there's an inflation shock, inflation goes up, and workers quite rightly go, well, my pay pack isn't going as far as it was last year. I need to be compensated for that. And if the union is powerful enough, they can sort of claw that back and then some. And then you end up in, what we call a sort of wage price spiral, because the owners of capital, they just tend to increase their prices off the back of that, and on we go. So I don't want to say that workers having zero power in that negotiation is a good thing. I think there's a balance somewhere in the middle. But certainly since the 70s, when it was unions and collective bargaining was massively stronger than it is now and more prevalent throughout the economy, there was a greater risk that an inflation shock would become more persistent. It would become entrenched in those negotiations and sort of persist into the future, which at the end of the day means interest rates higher for longer than they otherwise would be. The other thing, we sort of, like central bankers, we sort of get a bit of flack when we go, yay, wage growth is coming down. That's a good thing for exactly the reasons I'm talking about. It means that an inflation shock isn't going to persist into the future. We economists, we love wages going up because, that's a massive driver of well-being. Income really matters for well-being in the economy. But that improvement in wages, it needs to be underpinned by better productivity. So if we're increasing how much value add we create from an hour of work, some of that will flow to the owners of capital in the form of higher profits, higher return on an investment, and some of that will flow to workers, the owners of labour, in the form of higher wages. And some of it will flow to consumers in the form of lower prices. So we're all for wages going up, absolutely, but not when it's in the context of that sort of wage price spiral. That's unhelpful, but definitely when it's in the context of better productivity, high productivity growth, high wage growth economy. That's what we're aiming for.
It's interesting that there was some research at the conference which looked at how consumers were more sensitive to inflation shocks this time around, in part because it was harder for them to recover the ground with wage increases than it might have been 30, 40 years ago. And also, unlike 30, 40 years ago, when you could argue there was less market power in many industries, not just here, but all around the world, you didn't see prices necessarily, particularly the administered ones, rise as fast as wages. And so how was that change in the makeup of this, of wage setting and price setting? What implications does that have for how monetary policy works? Because on the face of it, there's a risk monetary policy becomes a wealth redistributor in that people whose wages don't keep up with inflation are punished and people who are able to increase their prices get higher profits. And if you're the owner of capital, then you're a winner.
Yeah, like absolutely. Monetary policy has distributional effects, and I think there's been a lot of work done internationally and at the Reserve Bank on the distributional effects of monetary policy. And we talked about the housing market is another great example of that over the COVID period. If you owned a house, yippee. And if you didn't, the housing affordability, that sort of dream of owning your own place, just got more and more out of reach. So I think it's very important that we understand these, from a social welfare perspective, absolutely, but also because it affects how monetary policy transmits through the economy. In terms of inflation over the COVID period, there's a heap of work around, including some that we've done. Households, once inflation gets above a certain level, the number sort of talked about at the conference was 4%. I think it's slightly lower. In New Zealand, households become laser focused on that inflation. So they become way more acutely aware of what's going on with inflation. And again, that can influence their expectations for inflation in future and sort of how hard they'll bargain in terms of wage negotiations and the like. And again, the comms around this can be sort of challenging. So, inflation expectations households don't like inflation. They see it as eroding their purchasing power, quite rightly. Like that's a very pernicious effect of inflation. But they do like wage growth. They see that as a sign of economic strength. So, it can be difficult, as I was kind of mentioning earlier, trying to tell people that falling wage growth can actually be a good thing when it is not underpinned by higher productivity. And just your last point there on administered prices, that's sort of for us in New Zealand currently, that's sort of the last holdout of persistent inflationary pressures in our economy. So more market-driven prices have returned to levels consistent with inflation at the midpoint of our target, but we're still seeing insurance is probably the exception to that, just given a sort of increased awareness of climate change risks. But also rates and other administered prices are taking some time to sort of get down to where they need to be from an inflation control perspective.
Yeah, just finally, you had a whole bunch of central bankers there who've grown up in this era of inflation targeting. They've risen to the top levels of their central banks, effectively as the chief priests of this new religion. That's probably a pretty strong way to describe it. But does everyone still have the faith? Because, there's a lot of people who don't have the faith anymore in the so-called neoliberal changes to the global economy over the last 30 or 40 years, politically at least, and you could argue some have used that reaction for their own ends, but politically at least in most of the world, it's seen as a bit of a busted flush. So was everyone at the conference there still true believers, or do some of them think, yeah, we're actually part of the problem here?
Inflation targeting, I don't see that as, I see that as a separate thing from, that idea of, what we call the Washington Consensus, which was a whole, sort of small government, low taxes, let the private sector get on with it. Like it's from my perspective, it's a different area of economics. And I understand if people sort of bundle those together and sort of feel that we've been let down by the whole bundle of policies, very loosely labelled sort of neoliberalism. I don't think inflation targeting sits with those other policies. And so yes is the answer. Like people, there was firm belief across the entire conference that inflation targeting remains fit for purpose after 35 years. No one has got another sort of option or that would be anywhere near as effective as inflation targeting. And, on the other bit, the sort of neoconservative or neoliberal sort of policy paradigm, I think there's some good truth in all of that. And I think relative to the world that we were in before it sort of came to be, highly sort of liberal. I mean, highly regulated. Think of New Zealand pre-1984, with minimum prices for everything and the government sort of controlling many aspects of the market. It's true, like those reforms in the mid-'80s for people that were there at the time, they've improved the way markets operate. And markets are incredibly powerful and play an incredibly important role in a modern economy. But I don't think that's not enough in the case of New Zealand to build an industry, to build an economy. It's more of a partnership between the public sector and the private sector. I think this idea the government should just get out of the way, I think that's a useful way to think in some instances, but in other instances, it's a partnership. And sort of the best recent example of this in New Zealand is Rocket Lab. So Peter Beck from Invercargill, same as me, sort of popped up and said, I want to fling rockets up out of Mahia, and we've got sort of clear skies. We've got a sort of comparative advantage there. And the government of the day, MB, said, oh, great, and created a regulatory environment that was conducive to that. And collectively, the public and the private sector came together and made something really good happen. And now there's over 300 sort of space tech companies in New Zealand. So, it takes a village to raise an economy.
Thank you very much to Paul Conway from the Reserve Bank, thinking big and wide and long about monetary policy. Great to have you on When the Facts Change. Ngā mihi nui.
Ngā mihi. Cheers, Bernard.
When the Facts Change was brought to you by the Spin-Off Podcast Network, together with KiwiBank. Visit kiwibank.co.nz to find out how KiwiBank are making Kiwi better off.
Kia ora koutou, this is Toby Manhire, host of the Spin-Off Politics podcast Gone by Lunchtime. Join me with Ben Thomas and Annabelle Lee Mather for a special live pod event April the 9th in Auckland at Q Theatre. We'll have bells and whistles and animals and children and special guests all gathered to discuss the state of the coalition government halfway through the term. That's April 9, Q Theatre. Tickets are available now from thespinoff.co.nz/events.
The Spin-Off Podcast Network.